Masterclass with super investors. Vijay Kedia. This guy is super interesting. We learn a lot from him. He says buy unknown companies which have capable management and which are available at low valuation, then you're going to make money. So that's his mantra. So let's see what else can we learn from Vijay Kedia. So he overall in his life journey, he has had several challenges. Like most of his life he spent through just rebuilding his life, and he shared some of that instances in the chapter, which is really interesting, and I'd highly encourage you to read it. But the courage part is what came out to be strong trait of him, and he's learned that from Rakesh Jhunjhunwala is what he says. And his grandfather was in stock market, his father was a trader, so he's had a family background of stocks. He actually got in at a very early age, 18 years. He got admission to stock exchange, and that was much, I think, few years lower than the committee guideline. But courage is something that you really see coming out strong, that he's built and he's used at his favor for investing. So his mantra again is unknown companies which are not known, the dark horses is how he calls it, capable management and low valuation, and ride the upside. And so how much risk you take depends on your courage, but also depends on your intelligence and luck, which was a key thing that he recognizes. And being on the side of stocks that are in momentum, and those stocks that are going to be riding the wave up, you want to be on that side instead of the other side, right? So stock momentum is very powerful. You want to be on the side of the stocks or the industry or the sectors that are going up. He's had several 10x's and even several 100x's, which was pretty amazing. And he got the courage to buy the 1% or even 5% of those small companies by talks that he's had with mentorship from Rakesh Jhunjhunwala, who really encouraged him and gave him the courage to say, hey, you can buy it if you really want to buy it. And he says management's more important in India than business model. And small caps move after large caps in the bull market. So they're all trying to tell us some mantra in which how you can detect whether the cycle is peaking up or the cycle is bottoming down. So that's his way of looking at. And he sees sectoral rotations happening, which, at any given 5-year, 10-year period, you will see the index composition very different, which is a really good insight. And identify the leaders, identify the sectors that are growing, and then be in those sectors. And when you sell mercilessly. Don't have a limit on sell. When you decided to sell, you sell. He's traveled several places, specifically in China, which helped him build conviction as to what he was seeing there. He could see it happening because he strongly believes that what happens in the world outside ultimately happens in India too. So you're looking for those trends and betting on those companies so that those new trends can be used for at your advantage, and you can bet on those companies from the trends you've already seen. If he sees a double in 3 years, which is already too good, like double in 3 years is like 26% CAGR, right? So 76 by 3, right? So yeah, so it's 26. Yeah, so he doesn't like that. He's like, I want to see a company which is at least a 10x possibility in 3 years. Whether that happens or not, that's okay, but he wants to see that potential. 2 or 3 good ideas is good enough, because if one of them works and becomes a 10x, huge. And he says before understanding the market, one should understand oneself. A lot of people in this Super Investor series have taught us self-awareness. So it's pretty critical. So stick to what works for you. Understanding yourself, understanding your mantra of success and repeating that success pattern over and over and improvising that is more important. Talking to management, do you talk to management? He says no, and he's come up with a really good way. He says, hey, if you board a flight, do you go and check with the pilot, or the co-pilot? Do you go meet them? Do you ask them questions? No. He doesn't like to do that. He doesn't do that. Good example. And number of years is not that critical, because it typically depends on the learning cycles that the leaders have had. Just because you've worked at a company for 10 years doesn't mean you really have built 10 years of experience. Maybe you've just had 1 year of real experience and repeated that experience for 9 more years, and you didn't really learn more. So he discounts that. His key is to look for strong athletes, or the dark horses, which have the companies that have done really well in the past, have been in the business, know their stuff in and out, but they have fallen for some reason, for some event that has happened. and the world is super pessimistic. And if you bet on those and those have a turnaround, then he really likes to buy those companies. And he only buys those companies which have a 10 years of track record. And it's okay for him to just completely skip companies that have just come up. And he wants to see those companies that have invested in the long run, have learned from those ups and down cycles, and have grown. And he has the SMILE principle. Every leader, every super investor has shared some mantra, and his mantra is SMILE. He looks for companies which are small in size, medium in experience, large in aspiration, extra large in potential. SMILE. Best time to sell is when management changes focus. That's his trigger. If the market is at 52-week high and your stock's 52-week low, that's a big problem. Introspect. Is this the company you want to be in? The steeper the fall, the greater the rise. Lots of really good insights from him. And the market is a place of regret. He says when you buy and the stock falls, you regret that you should have waited. But if you buy and the stock price goes up, then you'll be like, I should have bought more, right? So he says the market is a place of regret. Don't regret. Learned courage from Rakesh Jhunjhunwala and aptitude from Ramesh Damani. So he's had really good mentors, talked with them, learned from them. And the final piece is your mental capacity should exceed your financial capacity. If you don't have that, then you can't really make money in the market. You can't learn from just watching people do it. Like if you watch Sachin Tendulkar play cricket all day long, doesn't mean that you'll be a good cricketer. You have to learn by doing, but then you have to have the mental capacity. Your capacity to hold the financial wealth should be the prerequisite, and I think it makes sense. It's your ability to hold what you will get if you made a lot of money. So your mental capacity much more important than your financial capacity. So that's what we learned from Vijay Kedia, SMILE principle, and a lot more other insights around preparing yourself and building that courage that he built, right? The capacity to actually get the returns that he wants by doing what he does. Thanks.